6 days ago, I made this post and posted it to the community, and you guys voted on it. It says, I'm a full-time options trader, but how do you guys feel about options? 56% of you guys responded with, I don't understand options, but would like to learn. But if you are somebody that does not want to learn options and have no interest in learning options, trust me, this is highly recommended you learn options, because with options, you can make money when the stock market is crashing, and in fact, get insanely rich if you hit the timing correctly, and you can make money while the stock market is rallying up. So who wouldn't want to do that? If you don't know options, you're essentially trapped waiting for the stock market to continue to rally instead of playing the downside and playing the upside. So this is something you guys will definitely want to stay through. Even if you don't want to learn options, just hear me out, watch this video. At the end of the video, let me know if you just don't understand it or you still don't want to learn options. So that is what we're going to be going over in this video: how to trade options from a beginner's standpoint. What are options? What kind of leverage do they give you? Because options are leverage. So you can make more money with options than stock if you play this correctly. We're also going to be going over risky options and not so risky options, and what I personally like to do. So make sure to hit that like button for me, and that really sends me a signal that you want more options trading videos, and this is definitely something you really want to learn. I cannot stress that enough. Let me know down below in the comment section if you have any questions as well. If something wasn't clarified for you, let me know. I will be sure to respond to your comment, as well as subscribe to the channel if you are not already. Check out the links down below in the description. I have my buy and sell alerts in the Patreon, and I have a link to get $5 in free stock or whatever you want. 2-minute sign up, no deposit necessary. Get your free stock instantly. I got $5 worth of Tesla. Let me know what you choose down below as well. Now let's get into options. Now I'm going to demonstrate this on Robinhood, and if you guys don't have Robinhood and you want me to make a video about a different platform and how to trade options on a different platform, let me know down below in the comment section so I can do that for you guys. I pretty much have all of them. So the biggest thing is a call and a put. The way that I first learned and told myself the difference is a call, you're calling on the stock to go higher. That was just the simple way that stuck out in my head. You're calling on the stock to go higher. A call is basically betting you want the stock to go higher. That's how you make money. A put is that you're putting money down. You're putting something down, saying that the stock is going down, or you're just putting the stock down, whatever you want to call it. That is the simplest way that I have come to figure out the difference, and that was when I first started. Once you get that down, it's just a no-brainer. That will all come with a little bit of time. Just train your brain a little bit. So with options, one contract represents 100 shares. That's not as important to really understand. It is, but it isn't. So with calls, you have to really understand the expiration date. Well, calls are puts with options in general. The expiration date. So by saying I'm on CCIV, I'm on a call on Robinhood. So the $22 call for 26 cents. It says cents, but that's really $26. Same thing, $33, $44, $57, $73. It's just in cents, because that is essentially the premium you are paying per share, and each contract represents 100 shares. So don't get carried away with that. That really means nothing. So you're on CCIV. Say you bought this call for $22 that expires May 28th. That would be this Friday. So you are saying by buying this call that you think CCIV will close above $22 by this Friday. If it does not close under $22 or over $22, you will lose this money that you are paying. It is called premium. You will lose this if it does not close above your strike price. Now, it is the exact, same concept, but it's the exact opposite thing. So if you bought a CCIV $19 put for 55 cents expiring this Friday as well, you are saying that you think CCIV will close under $19. Now, the premium you pay gets important right here. It's not the most important thing unless you are holding these until Friday. Say you bought this and CCIV went down $1. You would be in the money because CCIV would be $18.78 because it's $19.78. So you'd be in the money $1, but you paid $55. So really you'd only be in the money $45. Now the contract can go up more in premium. That just means that people are anticipating anticipating CCIV keeps going down, but you will more or less learn that with time. The biggest and most important thing to understand about options is to be realistic. And what I mean by that is if you are paying the money for some of these options by your expiration date, the stock has to go to this option price. As far as a call, if you bought this $25 call for $10, CCIV would have to go to $25 by this Friday. Now, it all depends what kind of stock you are trading options on. You really want to know your stock, because if you think Coca-Cola's gonna go, up 10-15% in a week, if that's how far your option date is you're using, you're gonna lose money. Coca-Cola does not move like that. Now, CCIV can move like that, even though it's still unlikely, because I track CCIV and I know how it moves, but CCIV could easily pop 5% in a day. So that is quite possible. And right here, Robinhood does make it easy. This is your break even. So this is how much the stock would have to go up for you to start making money on this contract. So the $20 call, you would need CCIV to go up 4.80% to break even, to start making money on this. And they make it super easy as well right here. $20 strike, you're paying $73 for it, so your break even is $20.73. So anything above $20.73, that is where you start to make money. The same thing does apply to the put side, and Robinhood, like I said, just makes it really easy. So if you bought the $19 put, you're saying that you think CCIV will go under $19 by the expiration date, which would be this Friday. And like I said, don't trade any of these. This is not what I'm telling you to do. These are horrible options. So $19 by this Friday, and you would need CCIV to come down 6.72%. That is your break even column. And essentially it's taking 19 minus what you're paying, $55. It comes up 55 cents like we talked about. And then anything under $18.45 is your break even. That is where you break even on the trade. You won't lose any money. Now, if CCIV goes to $18, just hypothetically, you would make $45 on this contract, but that is not really something you need to get too lost in. Robinhood makes it really easy, so just be reasonable. What do you think will happen? What do you think is a high likelihood? And if there's no catalyst to make that happen, I wouldn't make the trade. But that is just telling you what it looks like, how to trade options. That is calls and puts. Now, as far as shorting the market, there's a lot of ways to short the market, and doing this in put form, because you can't, sell shares short like institutions can, at least on Robinhood, but you can buy puts, and that is essentially shorting the market. And there's a lot of different ways to do this, so I will show you guys the shorts that I do currently have as of right now, and tell you guys which ones that I like the most, because I do like some more than others. And the key here is, let's say in the SPY, this is the S&P 500 index fund, and if we pull it out to the 5-year, we could see in March 20th, 2020, the SPY went down to $228.80. This was a huge crash. You see this right here. Huge crash, historical crash. It happened very, very fast. People that had puts at the time made a ton of money. I can't even, try to explain that to you guys. They made a ton of money. They made a killing. But it's important to keep, this low in your head, because odds are we're not going anywhere close to our low in March. If we did, we have some major problems on our hand. So I like to just look at like the charts and look at like the last 6 months, what our low was, how much we have went up. So I do think reasonably we could go to about $320 on the SPY if we get a major correction. So I like to get something close to that. You don't have to get right at that, because you're not holding them all the way to expiration. If the stock market crashed tomorrow, went down 5-10%, it's not going to, but if it did, these contracts would go up a lot in value. You could flip them out, sell them out, whatever the case is, but I'm not going to hold these until expiration, so I don't really care. I just want something feasible that could happen. So I have a 350 put on the SPY, and I think that is feasible, but I do have the June 18th. I don't think that's feasible. So I am hoping that we start to get this crash or correction in the next couple of weeks, so I can flip out this contract and make my money and walk away. Like I said, I don't think the SPY is going to 315 by June 18th. That doesn't mean you can't buy this contract. That just means you have to be much more careful and faster to take profits. So there's really nothing wrong with that. But view options, you'll go out to, if let's go to the May 28th. That's this Friday. Let's go to puts. This is very highly liquid, so it does move around a lot. And even though, the closer to the money, you will make more money, but you have a much, much greater of chance of losing money as well. Like, actually, that's not a great example. Let's just go to the same one that I have. What, the June 18th chain? Let's go down here. Let's go to something unreasonable by then. Like really what I have is pretty unreasonable. So if you're buying this contract and just holding it, you're going to lose money. You're going to lose money on it 100%. 100%. That's saying we're going to have a 25% correction by June 18th. It is possible, very, 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 very unlikely. And I mean, that would just be perfect timing on your hands if that was the case. I don't like to try to perfectly time them. I like to just have the protection. So that's one way you can make a lot of money, as well as the UVXY $6 call. This is my favorite trade. And this is ticker symbol UVXY ProShares Ultra VIX Short-Term Futures ETF. Pull this out to the 5-year. It looks absolutely wild. And this is designed to go down in value. And essentially, let's take it back to before the Rona crash in January, February, we were sitting at about $10 before anybody really thought, something crazy was going to happen. We were sitting very low on this. And then once the market did crash, we went to $91.11. So if you are accurate and right on your prediction with this exact way to short the market, you will make a ton of money as well, and the options are cheap. So I currently have a UVXY $6 call for June 18th. So if the market did something like it did back in March, you'd make a killing. If it did the exact same thing, which I don't think it'll go down as much, if it did the exact same thing, I have a $6 call to $91, you'd make about $8,500 profit per contract. This contract cost me $50. So that would be a 8,500% gain. So you can make a ton of money by doing this, but I do specifically like the UVXY, especially right now, because this does monitor the call to put ratio. So a lot of calls are beaten down in a lot of stocks. So people are buying calls. People are also buying puts, but there's not a huge weighted difference in one or the other. Even though there's all these signs flashing that the market's going to crash or go through a correction, people aren't loading up on these. So this is a great time to buy some of these. But like I said, you still want to get a decent amount of time unless you are just playing these short term, trying to flip out of them. Now, if I was buying these from scratch, and what I'll probably end up doing is buy September calls, because this is an inverse. So market goes down, UVXY goes up. So you really can't go wrong going further down the chain, because if you get something explosive, you'll make a ton of money either way. So if you want to do the $25 call, which you're going to need a decent crash for this to make a lot of money by your expiration date, at $43, unless it happens really fast. But you bought this at $43, that's reasonable. All these are pretty reasonable. It just really depends what you are trading and, how you're trading it. This is still saying the UVXY is going up 592.03%. So I'm just quick to take profits in these. Stock market crash in the next couple of days, I would probably take profits on these, just because, like I said, I'm quick to take profits. I don't want to lose money if I don't have to. So that is another way. Really good way, honestly. This other one I don't like as much. It is the IWM, and this is the Russell 2000 ETF. Essentially the same thing as NASDAQ, S&P 500, or a Dow ETF. It just tracks the movement of the index. So I have IWM $200 or $110 puts, 2 buys at August 20th. And you got to keep in mind what has recently happened in history. So we went down to $101.40. That was a huge crash. Just look at that. Huge crash. So I don't think by any means we would go back down to there. But if we do start to come down, our support level would be at about 150 to 160. So that I think is more reasonable. But you can play this really cheap. So $14, you could buy a $110 put, agree to sell 100 shares, you don't have to own the shares to play options, but agree to sell the 100 shares at 110. And, you know, obviously I don't think it's going to go back down to there. Like I said, if it does, we're in some real danger, probably long term in that case. But I do have more time in this. I have August 20th. So if we do get a sharp downtrend, these will go up quite a bit in value, and then I will be able to sell out of them. So that is another hedge I have. I believe that is my only hedge. I do have TLT puts, which I'm going to make a whole nother video of. Michael Burry is shorting the bonds. I think this is a hands down easy trade, so be on the lookout for that. If you guys want to, you know, learn about this trade, I think it might be the best trade in 2021. Now, that is how to short, but how I like to play options for the long end, or like buying calls thinking it's going to go up a lot over time, I only pretty much buy the longer dated options. So the 2023s is the longest dated options right now, so that is the only thing that I have been buying, and that is the only thing you should be buying if you think the stock market is going to go up by 2023. And essentially, so I have the AMD 160 call, NEO $100 call, Palantir $50 calls, Viacom $70 calls. So by 2023, I am saying that I think AMD will be above 160, NEO above 100, Palantir above 50, and Viacom above 70. If none of these are above these strikes, I will lose all the money for these contracts. I think that is highly unlikely, though, given the growth these companies are going to have, and that's just where you have to be realistic, because this is about doubling from where the stocks currently are, essentially about doubling from where the stocks are now. So I do think these will, and if you don't think a stock will, then I wouldn't buy longer dated options like this. Now, there's some strategies you guys can do, like the ghetto spread, and that's what I really plan to do with a lot of these, but that's really a topic for another video. And the biggest thing I do need to point out as well is if you can't stomach watching a loss during a downtrend, because I only bought these contracts, you know, May 13th, couple months ago. I bought the first ones in February, literally not long ago. And if you can't watch yourself go down like I am right now, almost 56%, down $2,800, only having a market value of $2,230, spending $5,000 on these 10 NEO $100 calls, then don't buy options. Just buy the shares. Shares are a safer way. Options are definitely much riskier, but you have a much greater chance of making a lot more money. So if, let's say, hypothetically, NEO closed at $200 by January, by the expiration date, I would make $2,000 per contract, and I would have 10 contracts, so I would make $20,000. So I'm not going to argue with that whatsoever. And I do think probably that's the range we'll close at, maybe less than that. So I do plan, obviously, to make a lot of money on these contracts. If NEO just flops and just stays at these levels for years, then I will lose money on these. But that is all my conviction, and I am strongly convicted in NEO. But I don't only have options too. I have the shares as well. That's really how I do like to play these. That is going to wrap up this video. Hopefully you guys understand what calls and puts are, how to implement them, and kind of when to implement them, what the risks are, as well as the benefits, because there is always going to be a give or take, and options is a great example of that. So like this video if you want more content like this. I could go on and on and on with different strategies and different things you guys can do. Like I said, full-time options trader, I do this all the time. I pretty much have it all mastered. So with that being said, make sure to let me know anything I missed down below in the comment section, as well as subscribe to the channel. That is the main way to let me know you guys want more content like this, as well as check out the links down below, Patreon, and get $5 free stock in whatever stock you want. With that being said, stay safe out there, traders. Until next time, take care.